Hello and welcome to LiveSquawk's Market Talk, our weekly review on Friday, the 3rd of April 2026. A Good Friday for many. Every week, myself and guests break down the key stories of the week gone and look at the implications for the markets. We'll also preview the week ahead, providing you a heads up to what you should be looking out for. For this episode, I'm joined by Kevin Muir, the author of MacroTourist, or the MacroTourist newsletter. It's a daily publication. His tagline is, "All I bring to the party is 35 years of mistakes." Kevin has built over 37,000 subscribers on his Substack newsletter. I'll bring Kevin in shortly, but before I do, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. And that boring stuff's out of the way. We can now get on to the week that was, really, and as has become the norm over the last sort of month or so. The Middle East conflict really is dominating pretty much everything at the moment. The latest, for anyone who's missed it, Trump again yesterday threatened to leave the Strait of Hormuz one day and then suggests easily opening it the next. I mean, anyone who's missed it, he came out with a comment probably about a couple of hours ago now on his Truth Social, says, "With a little more time, we can easily open the Hormuz Strait, take the oil and make a fortune. It would be a gusher for the world." Question marks. As President Donald J. Trump. We also had non-farm payroll numbers out today, curiously, when most of the markets market participants aren't around. But when we'll come to that in a minute. But on the Middle East and the latest there, Kevin, obviously you've been across all this. From a trading perspective and from your perspective, what do you make of where we're at the moment and how the markets are receiving these almost daily headlines from the president, as well as what we're seeing in the conflict itself?
Well, first of all, it's great to be with you, Harry. I'm looking forward to this.
It's a real
In
pleasure.
terms of the president, holy smokes, is it tough to pay attention to every tweet and every change of opinion and the fact that he's all over the map. I actually think you have to almost ignore him. And I know that's probably not something people want to hear because the markets seem to be reacting. But if you look at the longer term kind of trajectory of the markets and what they're doing in terms of responding to each tweet, you'll see that they're actually becoming more and more cynical. And his original tweets that, if he used to suggest that they would be able to open the Strait of Hormuz, the oil market would sell off $5, $10, $20. Now, all of a sudden, he says that oil market dips $3 and then just keeps rallying. So we're at this stage now where the reality of the situation is much more important than what he's saying. And I think that that's kind of the big message that you should take. And in terms of where we're headed, it is difficult because there is a lot of optimism built into the markets. And I guess I shouldn't say markets because it depends on what part of the market you're speaking about. Some markets are more worried about this war and others are more complacent about the war. And I would say that, for example, the stock market, there always seem to be dreamers and people always, the stock market seems to be filled with people who see the world as half full. They're just buying every single dip. And if you talk to stock traders, they're fully expecting the situation to kind of resolve itself peacefully. And, a month from now, we're not going to be talking about this and we'll be on to the next thing. Then again, if you go talk to a crude oil trader, they're tearing out their hair and saying, like, I can't believe that the stock market and that the financial markets are so complacent about it. So it really does depend on which market you're trading and what's built in. And it is a very, very dicey situation. And one of the other problems is that we could talk about this and then all of a sudden everything will change tomorrow.
Yeah. Well, I think complacent is a word I've heard used by a number of my guests over the past weeks regarding some of the market moves that we've seen. And the underestimation of how long this potentially goes on for. And on the oil front, I totally agree. I mean, but then there's a level of fatigue, I think, with Trump comments and sometimes the Iranian comments, because they're coming from so many different places. You know, you don't know who within the Iranian establishment is now the real person in charge. I think on purposefully, that's the case. And like you say, with Trump, it changes from one day to the next. And even sometimes with his union address, or sort of address to the people, he says contradictory things within the same paragraph, even. So
within the same sentence sometimes, Harry.
Yeah, I didn't want to be that exact, but he's almost like that as well. It's astounding. So in terms of how do we, you know, and like you said, sometimes depending on the market, we're ignoring a lot of what's said. Do you have to take a more medium-term view of this then, rather than be reactionary for short-term traders? I know for intraday traders, it's all about the opportunity and getting in and out. But as an investor, do you have to take a mid-term view on this thing and take a step back, maybe?
Yeah, for sure. And first of all, in terms of the short-term traders, one of the things that I've been counseling is that volatility has gone way up. Make sure you trade smaller. And I keep saying that, and I just keep reinforcing that. The moves, like you'll go look and you'll say, oh, you know, the oil's in an uptrend. The front month rallied, you know, all day today. And then you go realize that they're rallied 11, 12 bucks. That used to be an entire year's move, and it just happened in a day. So one of the things that you need to be aware of is short-term traders trade smaller. In terms of longer-term investors or medium to longer term, I think you really need to step back and think about, is this changing the macro picture and how is it evolving? And I am of the opinion that although, you know, we could sit here and be frustrated that the market is not is complacent, I think therein lies an opportunity. And if you think back to the situation where we had in COVID in February, I was writing about the fact that there was this virus going around, and it was actually a big deal, and that you should pay attention, and that this was something to worry about. And the market was shockingly complacent. Nobody cared. It just seemed to be something that they shrugged off. And one of my subscribers was reminding me the other day that I've written about this, the fact that if you go look at 2007, I think it was, we had this situation where Jim Cramer came out and made this epic rant on CNBC where he started talking about the Federal Reserve knows nothing, and how the real estate problem was way worse than they expected, or the forecast. And it was just this, you know, 5-minute diatribe. And in my mind, but in my mind, that was always like at the point where it was very obvious and it was on the way down. Like he did that near the end of the move, not near the beginning. And then you go look at where it is in the chart and you realize that after that diatribe, the market, you know, fell like 2 or 3%. It was a 10% correction. And then guess what happened? The stock market rallied up to new highs. So the point being that even Cramer knew that there was all these problems and the stock market ignored it. So there are times when there's just some big, huge macro change that's there, and it's almost too large for the market to even contemplate it. And it doesn't get fully priced in correctly or even priced in at all. And I suggest that we might be at one of those times.
Yeah, look for the opportunity. Good. When I've talked to a number of portfolio managers, and their first quarter has been an absolute mess. You know, they were doing really well up until the end of February, and the last month, the volatility and everything, like you say, has just really just whacked them really hard. But as I say, you've got 3 quarters left to make the money back.
Right.
You know?
Actually, could we talk about that? Because I would love to. Okay. So what we had there in terms of the first 2 months of the year was what I called the immaculate rotation. And so if you kind of step back and think about the stock market over the last, let's just call it since COVID, we had this situation where the US was leading, AI was leading, growth stocks were leading, value was sold, the rest of the world was sold. It was just a nightmare. And not only that, the US stock market was getting more and more concentrated, meaning that the amount of market capitalization that the stock indexes were focused on those top 10 names, the Mag 7 plus a few other names. So it was just becoming more and more concentrated. And into that environment, it was very difficult for portfolio managers to outperform. And the reason is all of a sudden, if the top 10 stocks are 40% of the index, and those are the ones that are rising, you actually need to be overweight something that is already fiduciarily irresponsible to have that much of your portfolio in just those single names that happen to be in the same industry. So it was just kind of a nightmare for folks that were trying to manage money. And then what occurred was Trump came, and bit by bit, it changed the macro environment. And we can talk about my opinion on why that changed. But we eventually got this situation where we had this immaculate rotation where all of a sudden foreign stocks markets started outperforming. Value started outperforming. Small caps started outperforming. And it really gained speed in the first 2 months of the year. January and February were absolutely terrific times for the average portfolio manager, for everyone that was looking for this trend to change. And it was just shockingly awesome. And then all of a sudden the war came. And what we saw was that everyone that was chasing that new immaculate rotation were offside, too overweight. And then we got this return back into American stocks because it's the perceived kind of safe haven. We saw things like gold go down that people weren't expecting. And everyone was like, why is gold going down in geopolitical, conflict? And the answer was because everyone was long. And it was really, to your point about the fact that all these portfolio managers were feeling lots of pain, it was a real washout of that position of that immaculate rotation. Now the question is that an opportunity to put those trades back on? Is that trend going to return? Or are we back to the days of US outperforming and you should just chase AI stocks?
Well, again, there's probably a bit of scarring amongst those PMs there in terms of wanting to get straight back into it, but it's kind of their job, so I guess they've got to weigh up the pros and cons at the moment. But it's a very interesting point. I'm glad we sort of went into it a bit more. I want to move on now to employment, US employment particularly. We had March numbers out today, and it was a big surprise: 178,000 job gain versus the consensus. It was around 65,000. And we had a revision from last month, a fall of 92,000 to a drop of 133,000, I think. So a bit of a surprise. Again, we've had this volatility in the jobs readings of late as well. We saw it was 113 higher than obviously the consensus. Largest beat, says BMO, since January 2024. Private payrolls gained 186,000 versus a fall of 129,000. And 78 forecast. 3-month average payrolls were up 68,000 versus 3,000 prior, revised from 6,000. And this was the highest since April 2025. Unemployment rate unexpectedly ticked lower to 4.3% versus 4.4 and 4.4 consensus. And participation rate unexpectedly moved down a 0.1 of a percentage point to 61.9%, the lowest since November 2021. We'll come to the wages in a minute. On the face of it, how much do you read into this report and take it at its word, if you like, when we've seen such variables and such movement, not only in last month's numbers, but again, so far away from forecast, the consensus?
Yeah, so I think that the actual number came in higher than the highest estimate on Bloomberg. So it beat even the highest, the most optimistic forecast. One of the things that first of all, in terms of how much do I take into this, it's not whether I take into it, it's how much the Fed takes into it. Yeah. And I can't help but think that this ties the Fed's hands. It's going to be difficult for them to be easing in the face of higher inflation from rising crude oil price, and combined with an employment that just continues to, let's just say, not kind of release. And the other thing is that you highlighted the unemployment rate. It was actually even stronger than it seems, because although it went from 4.4 down to 4.3, it almost rounded down to 4.2. It was a 4.25 something number.
4.256. Yeah.
Yeah. So it was almost a 4.2 number. And so you're spot on to correct to point out that this is something that is causing the Fed to have to sit on their hands. But I think that the response to in the bond market was interesting. I expected the bond market to get absolutely decimated and for the curve to flatten. And maybe it's a function of nobody's in today and the selling is going to come on Monday. But it wasn't as devastating to the bond bulls as I might have thought. And interestingly enough, the S&P sold off after the initial rally.
Right.
And then the other thing I just wanted to highlight though is if you go and pull up the different monthly change by sector, and I created this great chart where I went through all the different ones. First of all, manufacturing since the Great Liberation Day and the expectation that there's going to be all these manufacturing jobs, they've lost jobs every month until now. So it's been, maybe now it's finally ticked up a little bit, who knows, but that's been a terrible disappointment. And when you look at where all the jobs are being created, it's almost all in education and health services. That's where the vast majority of jobs are being created. If you go look at information and technology, that's been losing jobs, huge function of AI. You go look at finance is also losing jobs. So one of the things that you might look at is say, sure, the employment report is strong, but where are the jobs getting created? They're increasingly getting created in an environment in jobs that are just taking care of older people.
Yeah.
And it is not a healthy economy.
It's not sustainable in that sense then.
Yeah, well, it's not something, it might be those jobs are needed as the situation changes. And I'm not trying to say that there's anything wrong with those jobs. I'm just saying in terms of the cyclical parts of the economy that should be doing well in an environment with positive, robust economic growth, you're not seeing a real uptick. And that's the thing that's scary. And again, it ends up being also compounded with the fact that there's this idea that the Americans are in essence deporting a whole bunch of people. So a lot of folks focus on this thing called the break-even rate. And the break-even rate in terms of employment is how many jobs you need to create to keep the economy growing. And if you get a situation where we get them actually getting rid of people, then you don't need as many jobs created because there's not as many people coming into the economy.
Yeah.
And so I just look at this and say, sure, this is on its face a strong report, and I don't view this as a positive for the financial markets, because I think that this strong report is actually kind of weak, and it ties the Fed's hands in terms of responding to what I think is going to be a weakening economy in the months and quarters to come.
That's a great take. What I would notice though, and I said we come on to it, average hourly earnings, they were up 0.2% on the month compared to 0.4%. So a slowing from 0.4 in February and 0.3 that was estimated under hit on that front. The year over year then therefore slipped to 3.5%. So again, you got this dichotomy with the wages versus, and it plays into what you're saying about it's not really as strong. The labour market's not really as strong as everyone's, as this number seems to suggest, really. But you've got dichotomy now with energy costs moving north, with wage costs appearing at the moment just to soften a touch, and it leaves, like you say, the Fed in this awkward position where there's no real urgency, which is going to be something that Trump and the incoming Fed chair Walsh are going to have to deal with, I guess, and live with in the short term. So it's very interesting.
By the way, can you imagine when Walsh comes and he ends up being the only time a Fed chair dissents against the majority? And I think that's something you should take into account that might actually occur.
Yes, a very good point indeed. Very good point. And obviously, we've heard from the current Fed chair that he's not leaving until he's absolutely, until we do get Walsh appointed. And even then, there is still doubts of whether he may well see out his term as a board member as well, which is
I think, he's not leaving, I think, until that lawsuit gets settled.
Yeah.
I think it's just a way for him to ensure that he's not leaving with this huge big mess. So he's viewing that as kind of the final part of his job, and he's not going to leave until it gets fixed.
It's going to be fascinating to see how the dynamics play out with that. Yeah. We want to move across the Atlantic now, and we'll take a look at this, a cursory look. But Eurozone CPI data, HICP, come in And we saw, no, I wouldn't say a surprise, but Iran war fueling rising costs. We're starting to see the effect of the energy price rises just starting to creep in now, and obviously I think there'll be more of an impact as we move down the line. But we saw that within the eurozone reading. You can, for anyone who wants to know, you can go to the LiveSquawk website, and we've got reports up on that. Eric Culp says eurozone inflation jumps as Iran war fuels rising costs. Prelim report, EU Statistics Office, Eurostat said annual Eurozone inflation last month increased to 2.5%, its highest reading since January of last year, to fall short of the market estimate of 2.7, but handily outpacing the 1.9% reading seen in February. This rise pushed the measure well above the ECB's medium-term target of 2%. Now, we're already factoring in hikes near the back end of this year for the ECB, and that may bring some of them forward. But the ECB subsequently have said, not subsequently to the inflation, but have said at the last meeting, they want to see how this war plays out. They want to see how the energy picture really plays out over a period of time before seeing how entrenched this rise in inflation really is. So it's going to be interesting there. We saw mainland China manufacturing PMIs out as well. Output growth was intact for the time being. Again, do you have any worries over the Chinese over the Chinese economy and just the global growth in general because of this war?
So I have lots of worries about global growth in general. I would actually say that China would be one of the ones that I was least worried about. I know everyone is always concerned about China, and there's all this talk about how it's uninvestable, yada, yada, yada. And I look at them and I say that they're actually navigating a lot of this stuff way more. They're, yes, they're the huge importer of oil, but they're also a huge user of electricity. And they've properly, developed a grid that's actually able to do this. And so when I'm thinking about this situation and about countries that I want to sell because of the war, China is definitely not one of them. And not only that, depending on how the geopolitical events unfold, we could see a situation where much more geopolitical power actually gets transferred to China if the US does not play this hand correctly.
Interesting. I want to stay in Asia. We saw Japan Q1 Tankan Index surprisingly upbeat, really, considering everything that we've got going on elsewhere around the globe as well. And I think the markets are still pricing in hikes for this year. Well, they're definitely pricing in hikes for this year for the Bank of Japan. It's a tough one here. Well, we know Japan are going to the Bank of Japan are going to hike. Do you see anything that puts them off track at all?
No, I don't. And I actually take a much bigger and longer term view when I look at Japan. And I know a lot of folks are actually actively selling Japan because they are one of the biggest importers of oil. And I completely understand that take. To me, that's already in the price of the securities. And when I think about Japan over the long run, it is my favorite stock market long. It's unfortunately one of my favorite currency longs, and I'd be completely and utterly wrong. I've added another mistake I've made there, Harry, with the
I'm so glad someone's actually honest enough to sort of say I make mistakes. No one's perfect, but the fact that you come out, it just honestly, it gives you more credibility.
Well, thank you. But you know what? I was very bearish on the US dollar a year ago, and I got my call right about the US dollar. And then unfortunately focused on the yen way too much. And it ended up being the weakest currency. The only currency that was weaker than the US dollar was the yen. So to me, it's all just setting up. Like when I think about the yen, like you go visit the place, and I took my family, and this was a couple of years ago, it was cheap. And that was with the yen at 145 or 140 or something. And here we are closer to 160. I just can't imagine that this is going to be something that is going to be accepted by the rest of the world. And in essence, by leaving their currency so low, Japan is in essence stealing growth from the rest of the world. Like if we stop and think about what Trump's trying to accomplish, he's trying to get manufacturing coming back to the US,
Yeah.
how could you possibly compete against a yen at 160? And I just look at this and say that in terms of the Japanese government, they're playing this terrifically.
Mm.
And if you think about their stock market and their growth, they don't want the yen to go up too quickly. Now, I understand it's probably gone too far now, and it's too cheap, and that in essence they're getting a little too much inflation. And
Yeah.
from
That's my
a
next question. Yeah.
right, like from a perspective of on their side of the domestic politics, it's probably not no longer playing well, and it is kind of this difficult part. And what I think is funny is all the folks that tell me, oh, the Japanese yen, it's doomed to keep going down, there's so much debt to GDP, yada yada yada. They give me all the kind of negatives, and I'm like, have you stopped and thought about who actually has the savings? Like, who is the
Mm.
biggest saver? Like, the US is running this monster current account deficit. They need every, day, every month, every, quarter, they need more and more money to go into their economy just for them to break even in terms of funding all of this. And that's
Sure.
coming from the Japanese. And I do have a theory that a lot of it was a function of the Japanese retail chasing the AI stocks. And if you go look at the stats, I think I wrote a piece about this in terms of the Japanese and Korean kind of retail chasing of American stocks. It is
Right.
huge. It is massive. And what are those accounts? They have some sort of account that I can't remember the name of it. They have an acronym for it, but it's in essence like a savings account or like a retirement savings account, and
Mm.
they allows them to invest in things, and all that money is just been going into the US. And I think that that's kept the yen weak. And one of the things I just wanted to kind of highlight is that if you go back to December 24th, Christmas Eve, the Korean government went and changed their policy in terms of the taxation to try to encourage money to come back to Korea.
Yeah.
And since then, we saw their stock market go crazy. And I suspect that there's going to be increasingly measures like that that are going to occur in Japan. And my big macro thesis is we have this prime minister that is in essence kind of the MAGA equivalent, like a nationalist prime minister that is going to do more fiscal spending and more Japan first type of stuff.
Mm.
And when that money is needed, in essence, what's going to happen is all the savings that is in the US from Japan, it'll come back. And if it doesn't come back in a form of just private savings, it's going to be instituted from the Japanese Postal Service or whatever that is, the largest pension fund in the world. They have 25% of their portfolio is foreign bonds. The majority of that is US stock or US bonds.
Mhm.
It would be super simple for them to just say, instead of 25%, that's 5%. And 20% of that come homes. And I think that what you'll find is that all
That
of
would
a
be
sudden,
monumental.
yeah. And I think it's coming. It's one of my big themes. And in the meantime, the stock market continues to do great. It's cheap and it actually earns money. It's just, I love Japan.
Awesome, lovely, nice to hear. Nice angle and take as well. We're coming to the end, so I want to sort of quickly sort of move on to what we have in the week ahead. One of your posts, you said the impossible FOMC meetings before the meeting, but you wouldn't want to be in Powell's shoes. We've got FOMC minutes coming this week. Really, I don't think we'll divine too much from the minutes that we didn't hear from Powell in a wait and see mode. There was a consensus, I guess, about where standing pat and waiting for things to develop a bit more. Is there anything in the minutes that you would be looking for particularly?
Well, in terms of the FOMC meeting, that was the one a couple of weeks ago when the war had just started, and we did have an increase in energy price. And the real question was, at that period, the market had, in essence, removed eases that like forward eases. And when Powell came out, one of the things that I thought was most interesting was that the FOMC actual release, it was only one dissent, which was Moran. And previously there was three dissents. There was Bowman and Waller. And
Yeah.
those were viewed as the other two doves. And by removing their dissent, the market implicitly assumed that the Fed was following kind of the tightening of front end money kind of policy. And so what we're seeing now is we're going to kind of get a little bit more clarity on that. But the problem is that even since then, the energy problem has got dramatically worse. Yeah. So it's almost like, yeah, sure, we can look at that. But the reality is that the situation is changing so quickly with the war on the ground that really there's not much to read into that.
No. And another thing, I think people at the time assessed the move in the markets was the Fed weren't being as overly hawkish as maybe the market had interpreted at the time, and that they were just, like you say, in that wait and see mode. But obviously we've advanced since then, and like you say, oil's remained above $100 for the majority of the time, and there isn't particularly that no one can see an end to this the conflict anyway, even though President Trump says 2 to 3 weeks. Today
it's kind of like Elon Musk's in two years to full self-driving.
Yeah, there you go. Yeah. So yeah, on that note, we do have CPI next week as well, which will be interesting to see whether some of the I know we were looking really for some disinflation to before the war started, some disinflation to start to creep in, and I think, from my understanding, people are more scared, and Fed officials are more scared about expectations, inflation expectations, than they are about 1 or 2 months worth of higher basket, higher index. Would that be your feeling as well? The expectations matter almost more than the actual figures that we're going to get out in March.
Yeah, I think you're spot on there, Harry. But the trouble is their response to the higher inflation affects expectations.
Right.
So it's a little bit of this kind of circuitous kind of feedback loop. I'm just pulling up the settings for this this coming CPI, and you can kind of through inflation swaps, you can see where the market is implicitly pricing it. And before the war, this was expected to come in at 2.4.
Yeah.
And since then, it's 3.3. So it's been a huge increase in expectations in terms of inflation. And the real question is this something that we're going to see for just 6 months and then it's going to go back down? Or is this something where, as you say, it's going to feed upon itself? I'm much more of the opinion that, especially if the central banks throughout the world tighten into this energy shock, that what's going to occur is we're going to, usher in the next recession, and that a year from now we'll actually be talking about lower rates because of the fall. And I just kind of go back, and if you go look at history and you look at all the recessions, you'll see that as this fellow Robert McNally that I recently saw interviewed, he says if a rising energy price is almost always at the scene of the crime of the kind of top in the economy and the ushering in of a recession. And to me, this is where we're at. And then the real question, though, ends up being, is it the higher energy prices that causes the recession, or is it the central bank's response to that causes the recession? And to me, I don't even know if it matters, because this seems to be that financial markets are implicitly tightening financial conditions on their own.
Yeah, absolutely. You're seeing that throughout the markets in the rates. So CPI will be the feature of next week, I think. And at Barclays preview here that says we expect March headline inflation to be the hottest since May 22. At 0.9%, 3.3%. That was a month over month, 3.3% year over year, led by surging gasoline prices. We expect core to have accelerated 4 basis points to 0.26 on the month over month, 2.7% annually, driven by core goods. Duration of the conflict remains key to the path for inflation. So, everyone is really I hate to use the T word, transitory, but to see it brings shudders. But that is really what everyone's waiting to see, central bankers as well. So yeah, it's interesting on that point. Just to wrap up, and we're getting the final reading of US Q4 real GDP. Obviously, it's the rear view mirror, and obviously we had the complications of the government shutdown for the GDP. So how much we can read into that is a bit dubious. And we've also got RBNZ that will announce policy. They're expected to keep rates unchanged for the main reason, as we've seen from other central banks. They want to see how the war plays out and how inflation and energy prices affect their economy. We are now at the end of the show. If you want to have a quick look at some of the topics of the week, we'll put up our focus on the week ahead over the weekend. You can have a look at what the banks are saying on that research. I'd like to thank my guest today, Kevin Muir, for his participation and honestly really insightful commentary on where we're at the moment in the financial markets. So, Kevin, thank you very much for agreeing to be on, especially on a day off for Canada and for the UK. But
it's my
thank
pleasure.
you so much.
I'm always love to chat markets, and it was really, real fun going through this with you. And if anyone wants to know more about me, just send me an email, kevin@themacrotourist.com, and I'll be happy to send you some samples.
Perfect, and we'll put all your details up on the site for everyone to look at. So thank you very much for taking part. Thank you everyone else for listening, and we'll be back next week to bring you more on the market. So thank you and have a great Easter weekend.